Good morning. We're almost at lunch, so hopefully this is incredibly exciting for everyone. First of all, just wanted to give you a little bit of an update on the format here. So we've structured this chat as a fireside chat because it's an incredibly important topic in this space. We thought it'd be helpful to have a one-on-one dialogue, a deep dive into the current state of evaluation here. So a little bit of background on myself. My name is El-Baz. I'm Chief Strategy Officer at HashKey, focusing on our trading platform. Prior to this, I had about 8 years building consumer technology products and IoT products. Prior to that, about 2 years in the financial industry. In addition, I did a master's at Stanford Business School, similar to Dmitry, and also was co-founder of what's now Stanford's largest blockchain technology community, about 600 people. So with that, I'll hand it off to Dmitry to chat a little bit about himself, and then we'll structure this in a series of questions and kind of go through some pivotal slides on the back here. So Dmitry, talk a little bit about yourself and your firm.
Yeah, sure. So, CryptoLab Capital is a quantitative investment firm, digital asset management firm, based in San Francisco, California. From the very beginning of from the foundation of our firm, my partner and I, both mathematicians by education, we felt that cryptocurrency investment lacks a data-centric, analytically rigorous approach to investing, and that's the vision that we have tried to communicate to the public, and that's the vision that we try to realize in our business on a daily basis. So from the get-go, we've been spending a lot of time thinking about the valuation models and doing a lot of different statistical modeling, valuation modeling, trying to understand, okay, what is Bitcoin really worth? This question came up a lot of times today and comes up every day in conversations. My personal background, I'm a mathematician by education, started my career in management consulting, worked in executive positions in tech companies in Europe. After that, I moved to Silicon Valley to do my MBA at Stanford, which is where I met Ben. And after that, between business school and CryptoLab, I worked at an early stage venture capital fund, splitting my time between New York and San Francisco. And the rest of the team is people with diverse backgrounds. Somebody comes from venture capital background, some comes from quantitative trading background. So we're trying to combine public markets, private markets, statistics, cryptography, and understand this space holistically.
Right. So another key point, the key points of this fireside chat is to really explore all the different approaches being taken to valuation by early investors in this space. And we'll go across a number of different areas. But I think the first question here would be talking a little bit about value at a high level, right? What is value and how do we measure it? So maybe you can chat a little bit about that, and we can chat a little bit about some approaches.
Yeah, absolutely. So everybody speaks about crypto as the new asset class, but I think there is one key blocker to adoption of digital assets by mainstream investors that is often overlooked and not spoken about, which is you can't invest in something that you can't value. You can't buy or short something that you don't know whether it's overpriced, underpriced, or fairly priced. And it has been mentioned today that this is not a unique situation for the new asset. We've been in the very same situation with internet companies back in the 90s. Today, this whole vocabulary of lifetime values, customer acquisition costs, and so on and so forth exists, but back then it didn't. And people were looking at eyeballs and traffic, and we all know how it ended. And I feel like crypto right now is in the same place as tech companies' valuations were in 2000, and it's the time to change that. So zooming out a bit, what is value, right? Let's look at traditional asset classes. For securities, value for investors is earnings, and the way you define the value is that you project all the future earnings, you discount them back to today. This is DCF valuation. Anyone in the audience from consulting or banking background definitely did these models at some point in their life. And this is how you define value for securities. Securities have cash flows. Commodities don't have cash flows. But there is a utility demand for oil, for example, from a oil refinery. And you only can sell oil for the price that oil refinery is ready to pay for the oil, so there is utility value. And fiat currencies don't have cash flows either, but there are certain macroeconomic trends and macroeconomic indicators like inflation interest rates, and so on, that define how much dollar is worth in terms of euros.
Excellent. So we're going to talk a little bit about some of the different approaches. So one of the reasons that we really wanted to get Dmitry here up on stage is Dmitry was one of the first early last year to really, in addition to a lot of the work done by Chris Bernisk and a lot of other people in the space, Willy Woo, to really dive into some details about using different methodologies, network modeling, currency, some extrapolations on currency modeling. You've done a lot of research on kind of top-down approaches, bottom-up approaches, comparative approaches, looking at transaction volume, looking at network size. Can you take us through some of the different approaches and their advantages and downsides?
Yeah, absolutely. So 3 very conceptual ways how you can measure value. One is going top-down, which is the favorite of all VCs and startup founders that, okay, gold is worth $8 trillion, Bitcoin can be 10% of that, so it's 800 billion, which is 10x from now, boom, amazing. This is not really a valuation. It doesn't answer the question, is Bitcoin overvalued or undervalued right now? It's an estimation of what it might be worth at some point in the future, which is not actionable. It's not actionable, it's not diligent. I don't think it's a valuation. It's an estimation, guesstimation at best. On the other hand, the second way to do valuation is bottom-up. Once again, DCF modeling. You define what does the company do. You define a number of assumptions. You forecast the performance of the company for some point, until some point in the future, then you discount it all back, the DCF model. And then you have the third bucket, which is comparative valuations, multiple-based valuations. You have PE, you have PEG ratios, price to book, price to sales, and all of those have been, all 3 of these have been successfully applied to Bitcoin. I'm not going to spend any time on top-down. This has been discussed many, many times. So let's talk about bottom-up. The most well-known bottom-up valuation approach for crypto is so-called quantity theory of money. The way it works, let's take an example. Let's take a coin, a no-name coin that supports file storage. And this file storage economy, we can think of it as an economy. And this economy has a GDP. This GDP is a quantity of gigabytes stored in the system multiplied by price of every gigabyte stored in the system. And this GDP, which is PQ, is supported by the money base M, or market cap of the coin M, multiplied by the velocity V, which is how many times a year does the coin change hands. The way this model is built, also very similar to DCF, it's very analogical. You have to forecast what will the price of file storage be. You have to forecast how many gigabytes going to be stored at every point in the future. You build a certain Excel sheet. You backpropagate it all to today. You get a estimation. I think Chris Bernisk done a lot of work on that. I see a lot of his books on the tables today. So there is an issue here. I like this model, but it requires a lot of assumptions. There is a reason why nobody uses DCF modeling for early stage startup valuation. You can value Apple using this, but you can't value seed stage startup doing this. You just can't assume well enough what's the trajectory going to be. So I think this model is amazing for understanding the conceptual drivers behind the valuation and the price changes, but it's not really actionable on a day-to-day basis just because it's a garbage in, garbage out type of situation when you just need to assume too much. That's why I like the comparative valuation most. And my favorite is actually using network value type of modeling. So there is a lot of real serious academic research on how do you value networks. Telephone networks, Facebook, fax machines. It has been done back in the 60s and the 70s. One of the most famous examples is Metcalfe's law, introduced by Professor Robert Metcalfe for Ethernet and fax machines for the first time back in the 70s. It says that the value of the network is not proportional to the number of users, but it's proportional to the number of connections between the users, which grows quadratically with the number of users. And This has been successfully applied to explain the valuations of Facebook and Tencent, actually. So Facebook and Tencent follow the same valuation logic, and WhatsApp, one of the examples that has been given today. And crypto and Bitcoin, more specifically, is the first time in history when all the transaction data and all the communication data is public. So we see every transaction that has happened and has ever happened. This is amazing from valuation standpoint. So what you can do, you can build certain statistical models and you can compare actual prices with the estimated prices. And if you look at the chart, the orange line is the actual price and the blue line is the estimated price. The correlation is over 90%. In any kind of real world science, this would be considered witchcraft. You never see correlations like this. Another thing you can do here is you can divide actual value by estimated value, and you can get a ratio. We call it network value to Metcalfe ratio. The idea is very similar to price to earnings, PE. We notice that every time the ratio goes above a certain level, historically this has meant that crypto is very overvalued, and there will be a correction shortly after. This is how PE ratio works, and this is how this analogical ratio for crypto works. So I think these are some of the thoughts on the bottom-up and comparative valuations. One more thing, very, very briefly, network value to transaction ratio. Also, I think in the book, Chris speaks a lot about this, and this is one of the first crypto valuation indicators that was out there. They call it crypto PE ratio when you divide network value by the transaction volume. And there are also certain strong statistical relationships that we have checked and we actually rely on between the ratio that you get and the price and the returns that happen after. It's very important here that these are not technical indicators. This is not technical analysis. We take the price in the numerator, but in the denominator and the valuation models, they don't take price volumetric data into account. We take the fundamentals of the network, and we try to construct the value using the fundamentals and not the price data.
Excellent, excellent. One thing that's really important about this entire summit, and also that's really important about this fireside chat, is really trying to explore the differences and similarities between traditional asset classes and the digital asset class. So it's incredibly important. So the goal of this fireside chat is to kind of share some of the ways that you can value this new type of asset class. So I think what could be helpful as something to leave the audience here today with, be helpful maybe if we could just do a little bit of a comparative summary of some of the metrics that are used in traditional asset classes and some of the metrics that we've talked about today that can be used in digital asset classes.
Yeah, let me give you some analogies and some comparisons. As any analogy, those lack some subtleties, and there will be certain kind of rough edges in these comparisons, but conceptually, the goal of this slide and the goal of this conversation is to show the institutional investors in the audience that there is a science behind this, and there is a total number different approaches that you can use to evaluate crypto. In the very same way, when you're evaluating a company for an M&A transaction, you would do a DCF model, but then you would compare it with PE and multiple-based valuations, and you would compare and contrast those, and if all give you the same valuation, good. If there is a discrepancy, okay, you dive deep and understand what drives those. So very roughly, once again, you can compare the DCF modeling with the MVPQ modeling because the structure of the model is actually very similar. On the comparative valuation side, you have PE ratio that you can compare to NVT ratio or to price to Metcalfe ratio in a way. PEG ratio, which is PE adjusted for growth, you can compare to NVTG ratio. We haven't spoken about it, but it exists and you can look it up. Price to book multiple, you can compare it to network value to hash rate. Why? Because hash rate is a proxy of total capex that the miners have spent to support the network. And then there are some crypto-specific things that behind me, network value to Metcalfe. I like this most because this feels like the most native way to evaluate crypto because they are networks and they should be evaluated as networks.
Excellent, excellent. And just last question, what's next for CryptoLab Capital and yourself? What are you guys doing next? What are you looking for next?
Yeah, so on the fundamental valuation research side, we've been working with academics. There are economics professors at Stanford and MIT that look at crypto as a financial asset and that do valuation research on that. So we work with them as well as with industry practitioners from traditional asset management and digital asset management. So I would love to talk to anyone from traditional finance or crypto asset management space who wants to learn more about this space, the research we're doing, or do this research together. I'd love to tell to people like pension funds and insurance companies how you can value this and how does this fit into the asset allocation of a traditional asset allocator. On the fund management side, we are currently raising our second fund that is going to be very heavily focused on quantitative trading. We've been doing it for the last couple of years. We had some successes, and that's the asset management part of what we're doing. So happy to chat with anyone as a follow-up to this about that.
Awesome, awesome. Well, thanks for everyone's time. Hopefully that was educational and shows you that there is some potential for analytical rigor in this space. Thank you.
Thanks.
Thank you, Dmitry. Thank you, Ben. A wonderful chat. Thank you so much.